Inflation has become one of the most powerful forces shaping financial markets today. What was once viewed as a temporary economic issue has now turned into a long-term factor, influencing how Wall Street allocates capital, manages risk, and builds investment strategies. In this video, we'll explore how inflation trends are changing the way major institutions, hedge funds, and everyday investors approach the markets. To understand these changes, we first need to look at what inflation really represents. Inflation occurs when prices rise across the economy, reducing the purchasing power of money. While moderate inflation is considered healthy, persistent or unpredictable inflation creates uncertainty. That uncertainty forces Wall Street to rethink traditional assumptions about growth, valuation, and risk. One of the biggest shifts caused by inflation is how Wall Street views interest rates. Higher inflation usually leads central banks to raise rates in an effort to cool the economy. As a result, low-rate strategies that dominated the previous decade are no longer as effective. Cheap borrowing, aggressive leverage, and speculative growth plays are being replaced with more disciplined and defensive approaches. Stock selection has also changed significantly. During low inflation periods, investors were willing to pay premium valuations for companies with strong future growth potential. Today, inflation has increased the cost of capital, making profitability and cash flow more important than distant earnings. Wall Street is now favoring companies that can generate consistent revenue and maintain pricing power. Pricing power has become a key investment theme. Companies that can pass higher costs on to consumers without losing demand are viewed as more resilient. This has pushed institutional investors towards sectors such as energy, consumer staples, healthcare, and industrials, industries that tend to perform better when inflation remains elevated. Inflation has also reshaped Wall Street's approach to bonds. For years, bonds were considered a safe and stable foundation for portfolios. However, rising inflation erodes the real value of fixed income returns. As a result, many investors are shortening bond durations, favoring inflation-protected securities, or reallocating capital toward alternative income-generating assets. Another major shift is in asset allocation. Traditional 60-40 portfolios, built on stocks and bonds, are being questioned. Wall Street firms are increasingly diversifying into commodities, real assets, infrastructure, and private markets. These assets tend to hold value better during inflationary periods and offer diversification benefits when traditional assets struggle. In conclusion, inflation is no longer just an economic statistic, it's a central driver of Wall Street's strategy. From stock selection and asset allocation to risk management and long-term planning, inflation trends are reshaping how capital is deployed. Investors who understand these shifts are better positioned to adapt and protect their portfolios.